Indexers Premium, and we're going to have today a class or a session on IAS 16, that is International Accounting Standard 16, which is called PPE, standing for Property, Plant and Equipment. We are going to solve practical questions on this. And before we start, when we talk about PPE, Property, Plant and Equipment, is basically for use, or let's say also for sale, but mainly it's for usage or for use. So use or usage. And don't forget to subscribe to Indexers Premium. We have a lot of lessons and tutorials to offer you. Alright, my partners and I. Alright, so PPE is about the use or usage of assets. And PPE is an asset. So it's a combination of property, plants, and equipment. Now, we've had several teachings on this before, and we are looking at what is called in IAS 1, we're talking about recognition and measurement. Recognition and measurement. Now, when we say recognition, we are looking at the concept of trying to record the assets. So usually we would say initial recognition. Then the measurement criteria or the measurement is that we are trying to look at how to cost it, how to value it. Alright? So for PPE, which is IAS 16, we are looking at the fact of what is called initial recognition. And then what is called subsequent measurements. So actually, this video is being taken as I'm having a class with some good students. Therefore, I'll be engaging them. Alright? So sorry there are some few interruptions because they're also watching me having the video together. So I think we all recall this. Initial recognition, subsequent measurement. And we said when we deal with the subsequent measurement, there are two models we are looking at. We are looking at what is called what? The cost model and what? The revaluation model. So this is the CM and the RM. Okay? And we saw some practical examples on the initial recognition before. That is when an asset is newly bought, how do you recognize it? Initially recording it in the books. Okay? Then we have what is called a subsequent measurement. We have the cost model and the revaluation model. Today we're going to pick one question which will cover all these PPE. Again, PPE is an asset, non-current assets. The properties of the organization, the plants and the equipment. That's what we're trying to do. So let's take one example which we are going to solve together. Okay, which we are going to solve together. Alright. So in solving it, we are going to meet what is called a cost model and the evaluation model. So we learned that when we talk about the PPE, we are having the initial recognition, and then I'm just repeating what they say. Subsequent measurements. So let me just say something briefly about this. When we're talking about initial recognition, when we first obtain the assets, how do we record it? How do we record the assets, the PPE? It must fall under this. And then when we're talking about the subsequent measurement, we look at the cost model and the revaluation model. The cost model, we look at two areas. We look at what is called depreciation, and we look at what is called impairment. So these two help us to structure properly the cost model, right? Then when we talk about the revaluation model, we are looking at what is called revaluation amount. What is the revaluation amount on the assets? So let me speak a briefly about this initial recognition. That is, when we first obtain the asset, how do we record it? We can obtain an asset by purchasing a complete asset or by constructing a new asset. So let's say in UPS has a learning block, a twin tower block which they are building for students, for studies, for academics, for tuition, for lectures. And this block, they built it anew. So all the costs involved in relation to the construction of the property they are all factored, or they are all capitalized under initial recognition. So it's different from when it is buying an already existing building. That one too is an initial recognition. So there are two ways, or let's say at most two ways. One is when you are putting it up anew entirely, the cost of the land, the professional fees, either as a loan, we complete the borrowing costs, everything into the construction falls under initial recognition. Or when the item or the asset being purchased anew, that's one we're not going to factor in the land, I will only factor in the cost of the purchase. That's one always comes under initial recognition. Subsequent measurement is after the asset has been completed and the cost recognition. Going forward, is the building going to cost the same or is going to change? It's going to change. And what are some of the things we are going to look at? Depreciation can affect the building. Impairments can also affect the building. So when depreciation is being computed or is being charged, the depreciation charge is being allocated to the asset. Which method are you going to use? Are you going to use a straight line? Are you going to use sum of year dividends? Are you going to use the reducing balance method? If it is, or as depreciation is affected, we also go with another way of subsequently measuring the property. Don't forget, measurements here, we're talking about costing, we're talking about what? Value. So subsequent measurement is subsequent costing of the existing asset. Are we going to use the, after depreciation, what is the new cost? After computing impairment, what is the new cost? After everything, we can revalue the property. Revaluation amount. So you are going to hear words like carrying amount. Carrying amount. What is the carrying amount? Carrying amount is the amount you are going to carry, amount of the asset you are going to carry to the other year. We're going to hear words like net book value. So net book value, which is called the NBV, is that the book value is the value or the amount of the assets in the books of the company. When we say net, we are trying to say something has been deducted from the book value. So the balance, the difference is called what? The net book value. So we are going to use this often. Depreciation, we are going to use net book value, carry amount in our computation. Then we're also going to see something which is called accumulated depreciation. Accumulated depreciation. So depreciation is charged annually, right? Let's assume it's annually. So it is annually when we charge depreciation, we have to report in the financial statement, profit or loss statement, which will also affect the PPE total amounts, right? To be treated in the financial statement. Accumulated depreciation is when depreciation over the years has been added together. That is accumulated depreciation. Princess, are you good? You don't sleep in my class. Accumulated what? Depreciation. So we're going to see this in our computation. So now what we're going to do, we're going to take a practical question and we'll solve it. And we will look at how they are treated in the financial statement. Alright, now, and also how they are treated in the asset account. Asset account or the real account of the PPE. Okay, now let's start with a practical question. Alright, so someone should read for us. Jennifer, come and stand here so I can hear you. Well, let me come first.
So, Northern Limited purchased office building on 1st January 2012 for 140,000 Ghana cedis. The company uses 5% reducing balance method on the office building. On 1st January 2016, the office building was revalued to 135,000 Ghana cedis, and depreciation on office building is computed at 4% reducing balance. Management of the company adopted the revaluation model, and revaluation for subsequent years are as follows. 1st January 2017, it was 130 Ghana cedis. 1st January 2018, it was 12,000 Ghana cedis. Required A. Determine the carrying amount of the office building as at 31st December 2015. B. Account for the revaluation surplus or loss for 31st December 2017 and 31st December 2018.
Alright, so this is a question under IAS 16, alright? Provided for improvement. Now, we could see that some of the items to pay attention to in the question are the years, right? The year, the reporting years, alright? The currency, that's the monetary concepts, right? Monetary measurement concepts in accounting. Which currency are we dealing with? I don't know what Ghana is. What is the reporting year? You have several reporting years. What's the first reporting year you read?
1st January 2012.
1st January 2012. And what's the last year? 2018.
Yes.
So from we are going to compute from 2012 to 2018. Then how they are treated. There's a part of the question which is not part. I'll talk about how should we report them in the asset accounts or the PPE accounts or the building accounts. And then how should it be reported, the extract, profit or loss extract. I also add that one in addition. So first, what you must first do is simply we bring in the Ghana city sign. What's the first year? 2012. Remember, in accounting, periodicity concept, we are looking at the period in which you have to make our reporting lines. Okay? So it's annually. So you have to compute it annually. From 2012, I'm breaking it down. We can use another method, but I want to use a very simple method, which we all can understand. Right. So in the 2012, what's the cost of the asset? Which asset is in question?
Office building.
Office building. So let's use building. Don't forget, building falls under what? PPE. It's for use. So it's a PPE. So cost of building.
140,000.
Cost of building is 140,000. Then it says there was a depreciation. So originally, when they bought the asset, it was 140,000. Let's say at the beginning of the year. That's when they bought the asset. Then the depreciation policy was what?
The company uses 5% reducing balance.
So the depreciation policy or method is reducing balance. And what is the depreciation rate? 5%. I know. So let's speak a bit about depreciation. Let's pay attention. Let's use the two. That's the straight line. Straight line and what? Reducing balance. So the straight line, the common formula for straight line is right. We will say it's the costs of the assets minus the scrap or disposal value all over the estimated useful life. So with this, we're going to have the depreciation charge on the asset annually, right? Sometimes, so this is how when you are calculating for the depreciation charge. So we can compute depreciation using the depreciation charge or using the depreciation rates. Alright, so we can give a specific charge of depreciation, then we use the charge. Also, you can be given the depreciation rates, which will help us go and compute what? To help us go and compute the charge. Then we come and compute the charge. As in, we will come and adjust the cost with the depreciation charge. Do you understand it? Do you understand it? So let me limit it to these areas, then we'll start. So, this company's depreciation policy, you are going to charge depreciation at a 5% reducing balance. According to PPE, one method of depreciation should be chosen for a particular period of time. So for one asset, I cannot choose depreciation, then choose straight line. That's according to IAS. I can choose one method, which is, let's say, reducing balance as the company chose or has selected. Now, so we're going to calculate the depreciation for 2012, right? What is the value? 5% of what? The costs. So with depreciable rates, we compute the percentage of the cost. Right? So tell me what you obtain for this. We've done this before. Alright? So there are certain stages when we reach, I'll actually be telling me, giving me solutions, right? Contributing to the solutions. Right? Alright, so 5% gives me 7,000 cities. Is that correct? Is that correct? Yes. Then we have to less depreciation as a cost, as an expense from the assets. I hope you all remember Alex, right? Alex, right? You said A stands for assets, liability, income, capital, or equity, and what? Expenses. Then we said in a T account, you have an account name or the type of account. Is it a real account? Right? Is it a nominal account? Is it a personal account? And the first A and the last E comes to the debit side. The debit side. And the middle L, I, and C goes to where? The credit side. So for every asset, there's a debit balance. Every expense, there's a debit balance. And we record expenses for what? Losses. And then we record here liabilities, income or what? Gains. So with depreciation being an expense, okay, we less it out to find out the difference. Are we good? Are we good? Now, so 7,000 minus 140,000. What do we have? 133,000. This becomes either the net book value. Let's say this is the net book value or the carrying amount. Net book value of what? Carrying amount. Why carrying amount? It is the amount to be carried over to the next accounting period. It's the amount we're going to use for the next. Are we good? Are we good? Any question? So we close it off for what? 2012. 2012. Are we good? Are we good? Then what do we proceed to? 2013. So in 2013, pay attention. In 2013, this carrying amount becomes the new cost of the asset. We good? So I write here what? Carrying what? Amount. This is the CAD's carrying amount. What's the carrying amount? 133,000. Are we good? Are we good? Then we also compute depreciation for this year. So what is the depreciation value for this year? Pause it for me. Alright, so let's do some few computations continuing to do what we studied. Now pay attention. The depreciation policy is reducing balance. Reducing balance means that we can compute the depreciation on the balance, which is the current amount. Right? So the balance is reduced. Now, let's say I'm using two methods to compute the depreciation for 2013. Now, I can find a 5% on the balance, which is what? The current amount from the previous year, which is 133,000. Now, when I compute this, I'm going to have 6,650. This one method, where we can compute 5% on the current amount. Another method is this. Let's use the same. So 2013, this is our 20 method. Ghana series. I'm having the current amount. The current amount will become the new cost of the asset for the subsequent year after depreciation charge has been lodged. So we use the depreciation rate to find the depreciation charge. So current amount is 133,000. Now I want to compute depreciation for the year. What I'll do is I'll say 5/100 times into brackets the original cost of the asset. What's the original cost? 140,000 minus the depreciation for the previous year. Minus the depreciation for the previous year, which is 7,000. When I compute it this way, I'll still arrive at the 6,697. So there are two methods. Either you compute the 5% on the current amount to have the depreciation charge for the year. They will never be the same. Straight line method gives the same depreciation charge each year. But for reducing balance, the balance keeps changing. The depreciation amount for each year keeps changing because it is computed on the current amount, or you take the NBV, you take the cost of the assets minus the accumulated depreciation times the depreciable rate. That is the depreciation charge. So over here, I took 5%, which is the policy, and with the depreciation method, reducing balance. Then the cost of the asset, the original cost, initial recognition, minus the accumulated depreciation. But here we say depreciation for the first year, so it's not accumulated. That would also give me the depreciation charge for the current year, the same. So with these two methods, usually the easier is this method. So let's adopt this method. And I believe you will understand. If you have any questions, you can message us in the comment section. Or we also have an email where you can send us an email and we'll respond to you. Therefore, what do we do? To find the net value, as I said, is a net. Meaning something has been deducted from the current amount or the book value to give us a new net book value. Therefore, we will say 133,000 minus what? 6650. Which gives us what is called 126350. This becomes the current amount for 2013. So having seen how reducing balance works, where when we use reducing balance, the depreciable charge or the depreciable amount differs from year to year. However, if it's a straight line or where it's a straight line method, the depreciable amount will be the same for each year. Because it's only at cost, meaning you find the depreciable rate on the cost of the assets. Are we good? Are we good? Right. So let me take this out. Then we proceed to 2013, we move on to 2014. The same. I shall have brought my Ghana city here. So Ghana city. The monetary measurement concept in accounting. Ghana city. Current amount is what? 12,6350. That becomes the new cost of the asset for the new year. Or the current amount is the same as what? The net book value. But let's use current amount, not the net book value in this instance. Because we're going to subtract the gain from the current amount. Then we come with the depreciation for the year. So what is the depreciation charge for 2012? 7,000. Depreciation charge for 2013? 6,650. What is the depreciation charge for 2014? It is 5/100 times the cost, 12,6350. So 0.05 times 12,6350. Okay, 126,350. 126,350. We are going to have 6317.5. Let's maintain this. Right? So this we're using it to like computing the depreciable rate on the current amount, use the reduced balance of the assets. So we are computing on it. Alternatively, you can go by this. Ghana series, the current amount, which is what 126350. Then here, instead of saying we also go with the depreciation, then what do? We find a 5% rate times into bracket. What is the original cost of the asset? 140,000. That's the initial recognition. Less accumulated depreciation. So what we are going to do is that we will add 7,000, add 6,650, which will give us 13,650. This 13,650 is the accumulated depreciation on the assets. For how many years? 2 years. So we added 1 and 2. It should give us the same figure we have. Let's say 0.0065 into brackets 140,000 minus 13,650. It's giving us the same figure as well. 6317.5. So this the cost of the asset minus the accumulated depreciation. So therefore, whichever method you choose, you should arrive at the same value of depreciation charge for the year. So accumulated depreciation means we add the depreciation from the first year of being charged to the current year. So here, 7,000 2012, 2013, when we add these two, it's accumulated. Accumulating is to add up to to add up, to increase, right? To sum up. All right. So let's find our figure for this. So I will have this figure here minus 126,350. What do we have? We have 1,232.5. This becomes the carrying amount. Are you? That is 2014. Then we go to 2015. Then you use another method, very simple, but I prefer we use it, break it down this way for us to understand. Now, the 2015, we are going to have again the carrying amount, or again, don't forget, the carrying amount is the net book value. Carrying amount is you carry the amount you have, you carry it to the next year. There you go. So since you are having 6317.5, 1000.5, let us approximate it. Okay, so we can be able to do away with the decimal fraction. So let's make it 122033 for convenience. Let me just approximate it. 120033. We go. Then depreciation for the year. What is the depreciation for the year? 500 times what? 120033. You go. So 0.05 times 1200. We are having another figure of 600.1.65. Let's approximate it to 6002. Okay. 12003 minus 6002. We have 114031. So we are approximating them. Right? We are approximating. So we have 114031. This becomes the carrying amount for 2015. Let's go to 2016. In which year did the company express revaluation?
Revaluation is 2016.
Is it 2016? Check it out.
Yeah.
Okay, so let's do that. Now, don't forget, we have computed the calculations from 2012 to 2015 each year. Each year. Why? Because of the reporting line. So, if the company wants to report in this financial statement in a particular year, the depreciation to be charged, we are going to have 7,000 as the depreciation to be charged. In 2013, what is the depreciation to be charged? 6,650. In 2014, what is the depreciation to be charged? 6,317.5, approximately 6,318. In 2015, what is the depreciation to be charged? 6,002. So each year we know the depreciation charge to be reported in the financial statement, in the profit or loss account. Okay, let's continue. So what happened in 2016?
On 1st January 2016, the office building was revalued to 135,000, and depreciation on office building is computed at 4% reducing balance.
In 2016, the office building was what? Revalued to
135,000.
Now, here the question is that if in 2016 it was revalued, are we going to charge depreciation in 2016 before revaluation, or will not charge depreciation until we begin revaluation? We are going to revalue the assets, right? Just supposing the revaluation amount against the carrying amount. So the revaluation will be at the end of 2016. Was it at the end of 2016?
No, it was 1st January 2016.
So in 1st January, the asset was what? 1st January. If it were revalued at the end, you have to find a way to compute what? Depreciation. Because if it were done at the end, you have to compute depreciation at the end of 2016, right? At the end of 2016, and then we would then look at the revaluation gain or surplus. Are we good? But here it was on the 1st January, meaning this carrying amount here will begin the year, right? Carrying amounts. What's the carrying amount value? 114031. Are you good? Then, since it was on the 1st January when the revaluation took place, we will come in with what? Revaluation amounts. How much was it?
135,000.
Mind you, the revaluation was not at the end of the year. If it was at the end of the year, we will quickly complete the depreciation charge at the end. For the question, the depreciation is charged annually at the end of the year. But here, the revaluation was done on the 1st of January. So we're not going to compute any depreciation at the end. Meaning, at the beginning of the year, then the company revalued the amount to 135,000. However, if the revaluation was done at the end of the year, we will compute depreciation on the current amount at the end of the year. Then at the end of the year, we find the current amount and then bring in the revaluation amount. Do you understand the concept? Do you understand the concept? But here, it's the revaluation was done at the beginning, 1st January. Therefore, we will compare the current amount at the beginning with the revaluation amount the company obtained at the beginning of the year.